The stock market is a completely different ball game, and you have to understand it. And I was just speaking to one of my clients recently, just explaining about how I make investments and what they should ideally be looking out for. And I mentioned the word PE ratio, and they didn't completely understand it. So I thought this would be a perfect thing to talk to you guys about some of the terminologies that you should understand if you are trying to invest in the stock market. Now, I don't want to make it super complicated. You don't have to understand it. You don't have to implement it, but it does make you a significantly better investor when you understand these things. So I'm going to start with something called debt to equity ratio. This is also recognized as DE ratio. Now, it's important if you're going to play the long term game of being in the stock market, as you start to get a bit more money, become a bit more advanced in your decision making and the companies that you invest in, these things will help you understand it. So, debt to equity ratio, DE ratio, effectively compares a company's debt, so money that it owes other people, to the money that it actually has. So let's take, if you owe company A, so let's say company A, how much money it owes company A in comparison to money that's been invested by shareholders. So that means the equity money within the company. There's a formula for it, but I'm not sure you guys are interested in formulas, so I'll leave that out. But in fact, let me just tell you the formula really quickly. It's actually something I've learned recently, so maybe I'm just showing off. So DE ratio equals the total debt. Let's put this here. I'm not going to go through the rest of the formulas, but I think if you are serious about learning this stuff, I'm sure this is going to be a good lesson for you. Divided by shareholder equity. That's the formula. What that tells you, the results, the answers that come out on that effectively shows you how much money or how much the company that you're thinking about investing in relies on borrowed money versus its own money. So, is this company surviving because it keeps borrowing money, or is it generating its own money? Does it have enough investor money, meaning shareholders? So, when I say investors, I mean shareholders, which is technically the company's money. Now, if you have a high debt to equity ratio, so a high DE ratio, then the company's heavily financed by debt. And then you've got to ask yourself a question: do I want to invest in a company that's heavily financed by debt? Because it's risky if the profit drops. So if they can't service the debt, if they can't pay back the debt, then that company's in trouble. So that's a quick analysis that you can do to help you determine whether a company is going to be in trouble in the next 2, 3, 5, 10 years, because we're investing for the long term and you want to know the health of this company. Now, if it has a low DE ratio, which means the company relies more on shareholders' money, so its own money, then it means it's safer. So a lower DE ratio means the company is a safer option to invest in than a higher DE ratio. So I don't keep it too long. I'll move on to the next one. Another one. So I mentioned that I was having a conversation with a client. PE ratio. PE, we might have spoken about this previously, stands for price to earning ratio. It shows you, and the reason I use the word show is because of these formulas. But again, I'm not going to waste time going through the formula on PE ratio. You can, if you ask me in a comment section, maybe I can just write it in the comment section on YouTube for you. But PE ratio shows you how much investors are willing to pay for £1 of the company's profit. That's it. How much is an investor willing to pay for £1 of the company's profit? So if the company has a high PE ratio, investors expect, effectively, the investors are expecting a strong growth in that company over the future. Now, it might be expensive. It might end up being expensive, but if it's a low PE ratio, the stocks might be undervalued. But it could also signal a slow growth in the company. It could show that the company isn't growing as fast or as buoyant as it could be. What I'll do here, actually, I'm going to do the formula because I actually like doing it. PE ratio, okay, PE ratio equals the stock price So you take the stock price of the company that it currently is at the moment, okay, and then you divide it by the earnings per share. Earnings per share. And that will give you the numbers that you need to look at. In fact, let's do this here. Let's say the stock price is £50. Stock price is £50. Earnings per share, EPS, let's put the EPS, is £5. So your PE ratio is going to be £10. That's it. So remember, the PE ratio is your stock price divided by your earnings per share, which therefore gives you £10. So it means investors are paying £10 for every £1 in profit. The reason this is quite cool and quite important, it tells you what other people are thinking about the company and why other people are investing in that company. And that allows you to know whether you're in good company. Are professionals seeing what you are seeing, and therefore you're making the right choice? And then number 3, which is something I've learned recently actually, it's a price to book. And I had to research this a bit more as well. Price to book ratio. That effectively compares the stock price of the company's, let me put it this way, let me draw it out. So it's PB ratio. The other one was PE ratio, and the other one is PB ratio. So it takes the stock price to the company's net assets, and net asset is of course their assets versus their liability. Let me show you the diagram on this. So PB ratio, okay, equals the stock price, let's put SP, and then the book value per share. Book value per share. And what that effectively tells you is if it's a high PB, it's a high book ratio, investors pay more than the company's net asset. And that's usually for, let's say, growth or companies with strong brands. Or if it's a low PB, the stock might be undervalued. Let me round this up because I want to keep these training videos relatively shorter. But if you understand it, if you don't understand it, let me know in the comment section. Let me know what you would like to understand so I can create more or maybe answer your questions better. So to round it up, as we mentioned, DE ratio is how much debt versus equity the company uses. And that helps you determine the risk. PE ratio stands for how much you pay for £1 of profit. How much you are willing to pay, or how much investors are currently paying for £1 of profit. And PB ratio is how much you pay for £1 of net assets. 3 very key formulas that investors, high level investors, use when it comes down to choosing a long-term investment that they are going to make. I hope that was valuable. Let me know your thoughts on the YouTube comments.